Good morning, Sarah, and indeed, special guest this morning, the new case for gold. We have the author of many books. This one, not only a good read, it's an easy read and an enlightening read. Jim Rickards, thanks for taking the time this Tuesday morning.
Great to be with you, Rick.
Listen, early in the book, you say gold is not a commodity. Gold is an investment. Gold isn't paper. So I ask you, Jim Rickards, what is gold?
It's very simple, Rick. Gold is money. And one of the criticisms of gold, you hear from our friend Warren Buffett, he said gold has no yield. Well, it's not supposed to have yield. Reach in your wallet or your purse, take out a dollar bill, hold it up. What's the yield? Zero. In other words, money has zero yield. People say, oh, I can put it in the bank and get some yield. Well, now it's not money anymore. It's an unsecured liability of an occasionally insolvent financial institution. Money market funds, the SEC just changed the rule that money market funds can suspend redemptions just like a hedge fund. I'm not saying it's high risk. I'm not saying take your money out of the bank. What I am saying is once you put it in the bank or money market fund, it's not money anymore. It's a liability. Pure money has no yield. That's why gold has no yield. But the way to understand it, it's just money.
Gotcha. All right. Listen, we've been off the gold standard since, well, the last vestiges under Nixon disappeared in '71. But nay, you say in some ways we're still on the gold standard, and your reference for this was kind of astonishing. You pointed to the over 110-to-1 leverage of the U.S. Federal Reserve's balance sheet. Explain.
Well, if gold has no role in the monetary system, why does the U.S. have 8,000 tons? Why do the members of the Eurozone have 10,000 tons? Why has China acquired 3,000 tons in the past 5 years, Russia over 1,000 tons? Clearly, there's a shadow gold standard going on. But to highlight this, if you look at the Fed's balance sheet, just the way they publish it, it's leveraged about 113-to-1 with a big duration mismatch. It looks like a really bad hedge fund. But if you take the gold, they have a gold certificate from the Treasury. They value it at $42 an ounce. But if you convert that into tons and market to market, about $12.50 an ounce, lo and behold, the Fed's leverage is only 13-to-1. It looks like a pretty healthy bank. That adds $400 billion of capital to their balance sheet. So gold is the hidden asset on the Fed balance sheet that keeps them solvent. If you didn't have the gold, occasionally they'd be insolvent, just marking the bonds to market. So gold plays a hidden role on the Fed balance sheet. Nobody wants to talk about it, but it's right there in plain sight. And I mentioned this in Chapter 1 of my book, The New Case for Gold.
All right, Jim, we only have 30 seconds left. I'm going to go fast. You know, much of the world has negative rates already. Eurozone, Switzerland, to name a few. The U.S., I'm not sure we're going to have it. The Japanese investors are rejecting it. How does negative interest rate future potentially, what issues does it hold for the shiny metal? Finish it out.
Well, one of the best things for gold are negative real rates. The problem with negative real rates, you have to get the nominal rate below the rate of inflation. As inflation comes down, you have to keep cutting the nominal rate to get to negative real rates. But they're going to chase it lower. They'll go negative if they have to. They already have. Negative real rates are very bullish for gold.
Excellent. Jim Rickards, it's a pleasure. We're going to have you back. We could go on and on about the precious metal. Simon Hobbs, back to you.